My name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. Beans in the teens once more, but this market, which continues to still have issues, may be coming to a cusp. Until this week, we'd seen a continuation of the bearishness seen since the failure to fill the overhead gap 1459 to 1467 from May 2014 at the height of the market 3 weeks ago. The move lower went down through the congestion stroke attractor at 1392, the flatlining short medium moving average currently 1391, the congestion at 1385 and 1365, and closing below the August to date uptrend currently at 1370 last Tuesday. However, that one close below was seemingly enough, as we had a combined key reversal up and bullish closing along White Mariposa yesterday. Today this combination is being countered, possibly what looks like a bearish dark cloud cover pattern. It has seemingly gotten itself stuck right now, just underneath the short moving average and above the 1392 support. Yet that was not the main feature. Instead, it is a pattern that is still developing. We are on for a possible weekly key reversal this week. If we close this week above 1403 or below 1391, then we'd be on. Otherwise, it will be a lesser outside week. This ongoing action trumps recent possibilities of a double top or a possible sloppy ascending triangle. It is very important now to not only see which type of pattern this coming weekend brings, but also will the market follow through with it afterwards. Chicago soybean meal. I wrote 5 weeks ago, and I quote, "We're in danger, should we close below the new short-term uptrend, since retired, of making a large bearish halfway hesitation from all the action this year so far. It is a little too early to confirm this idea, but I thought it prudent to look at any potential targets on the downside. I'd suggest a preliminary target X in the 382.5 area. Please note, this very much depends on smashing that short-term uptrend. Monday 4 weeks ago, the market closed below this new, but now retired, short-term uptrend. As recently as Monday last week, the market made yet another bearish action, this time a combined immediate countering key reversal down and bearish engulfing pattern and opening long black Mariposa. This was below the lesser 38.2% Fibonacci line of the August 2020 to January 2021 move at 399 even. It didn't work. The action failed, much as it had done the previous week and a half. And if looking back to November 2020, the highs there at this level of 399 even also failed. Initially, this failure last week was magnified by yesterday's bullish long white Mariposa, punching up through the medium moving average currently at 413.40. The short medium moving average also currently at 421.20, and the very recent 50% Fibonacci line at 423.5, closing over all three. Whilst not a weekly key reversal up, this threatens all three targets below. Target X for a bearish halfway hesitation in the 382.5 area. Target X1, an initial target for the possible roof stroke half diamond pattern, highlighted in red on my daily chart. That's in the 384.5 area. Finally, there's the lopsided possible diamond top pattern with a potential target X2 in the 379 even area. I finished last week with the comment, and I'll quote, "All roads here seemingly point to Rome, where Rome equals the 380 area." End of quote. That idea is not dead, but the bearish incentive has taken a body blow with yesterday's action. It's up to today's reaction to gauge how much that was really a hit or not. So far it seems the prices are countering well, with what looks like an immediate countering bearish dark cloud cover pattern, closing hopefully or not below both the short medium moving average, the 50% Fibonacci line, and also the medium moving average. We'll see how that does that tonight. We'll have to see if this is sustained. Chicago soybean oil. 5 weeks I drew a new acute bullish Andrews pitchfork from the late November 2020 to January 2021 action. Last Friday the market broke down through the lower time, currently at 51.52, and closed for a first time below it. I think I'll quote the end of my commentary from 2 weeks ago, which covers this situation. I quote, "Please note, the incentive is still bullish. We are still within the bullish Andrews pitchfork, and until this is retired or substituted, that is the way." The next supports are the March 2013 high at 51.26, the lower time congestion around the lesser Fibonacci level at 48.94, the big 50% Fibonacci line at 48.85, and a new one, the 2021 50% Fibonacci line at 48.06, end of quote. The market tried to revert back up this past Monday with a bullish harami, but failed to even hang a close on the lower time. This led to Tuesday's immediate countering bearish engulfing pattern. However, as I pointed out 2 weeks ago, we have as support, and I quote, the big 50% Fibonacci line at 48.85 and a new one, the 2021 50% Fibonacci line at 48.06, end of quote. The first 50% Fibonacci line slowed the decline, and the second halted it completely. Admittedly helped by the rising short medium moving average, currently at 48.03, and a November 2020 to date uptrend, currently at 47.81. This leaves us in a situation we find ourselves today. Strong support below, but a reluctance to move back up into the old bullish Andrews pitchfork, even a reluctance to hang a price or a close on the lower time. That is why I've kept the broken bullish Andrews pitchfork on my daily chart, as it still might have a use. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.